It's a 4-hour chart on the Canadian dollar and Japanese yen pair. And I generally don't like to trade yen pairs, but again, just to illustrate the effectiveness of the tools, I want to draw your attention to the fact that we had this nice rally up. Okay, we had this really rapid increase in price, about 500 pips or more between the low here in August to the high formed late in September. And I want to draw your attention to the fact that we had a few areas of where price could reasonably expect to see a bounce. You see this consolidation in here, and we had a consolidation here as well. Notice they are accumulating around old highs and lows here to the left side of your chart. Let me draw your attention specifically to this one right here. Okay, this is a down candle within this consolidation prior to the move out of this consolidation. In other words, we're going to be using the high of that candle as the beginning point of where a institutional order block may reside. Okay, and there's a few things that we could be utilizing in this setup. We could be referring to this swing low here prior to this rally up. Okay, and we're going to use the highest high, which is this one right here. Okay, notice we have a 62% optimal trade entry overlay right here. Okay, see how that's very close to proximity of that 94.60. We got 94.65, so it's only a variance of 5 pips. Nothing wrong with that. Okay, so anywhere between the 94.65, 94.60, maybe even 55 level to allow for some slippage, to allow those orders to be pinged. We could see a nice little bounce in here. Okay, and another area where we have consolidation, which is in here. Okay, prior to the rally up out of that consolidation, the down candle prior to the move is right in here. Okay, so we're going to use the high of that candle right in there. Okay, and if price trades lower and much deeper into that price swing, okay, we could use this low to this high, because we're looking at the range between the low here and the high here, much in the same way we did this low to this high. Okay, notice we have the 79% retracement level laying right on that same order block. Okay, so if the optimal trade entry sees price come trading down into these levels here, that could be a favorable area to be anticipating a bounce as well. Now again, all these levels do are highlight areas where on the smaller time frame price entry patterns formulate, okay, or come to fruition. And since we're teaching the optimal trade entry, which is the retracement inside of a price swing between the 62 and 79% retracement level, we would like to see a price pattern in the same capacity and a fractal nature on a smaller time frame, i.e. 5-minute, 15-minute. Okay, so with that said, let's take a look at what transpired. Okay, the first one we're going to look at is here and here, the second one. Okay, as price moved along, notice how price came right down to that level right there. Okay, and bounced up. Just in that little bounce right there, we're looking at a potential for price move of 100 pips. Okay, I don't know if you can see that, the middle number here, it's 100 pips. Nothing wrong with that. Okay, and that's intraday. Again, each one of these candles represents a 4-hour time period. Okay, price invariably goes lower, trades in the direction of the higher time frame retracement. Okay, and as price moves around, comes back up, finds some resistance to that same level twice, and then moves down to what level? That 93.37. Okay, 93.37. So we came right back down to this point of origin where this initial price move originated. Okay, price comes down, stabs through it, pinging any orders that would have been around that 93.35 to 93.40 level. Okay, and price proceeds to move up into present market. If you look at where we moved from this level here up to the high, now again, this is the best case scenario. That's 180 plus pips. Okay, just trading that bounce right here. Now what we're going to do is we're going to break that down and zoom in into both of those areas to highlight where price may have, because we don't know, I'm looking at these examples the first time, so I may be encountered with an opportunity that wasn't there. Okay, but for now we're just going to take a look at this here. And when price trades down into these levels here, we want to be looking for an optimal trade entry to key off of on a lower time frame. Okay, so we're going to do that now. Okay, we're zoomed in on the Canadian dollar Japanese yen pair. This is a 5-minute chart. This is the first of the higher most price levels that we were looking at on the 4-hour chart. And this is the day that the last video of this series was recorded and posted on YouTube. This is September 30th. And we're moving down inside of this 4-hour order block, delineated with this blue level in here. Okay, and when we look for specific price patterns, okay, there's a couple things we got to go back to. Remember, we're in the 5th part of the series, but it's not that you're supposed to forget everything we learned and covered in the previous videos. We're going to now go back throughout the first 4 videos and pull out some of the gems that you should have been gleaning and keeping track of on your little notepad, and hopefully you can start seeing these things start synergizing. Okay, when we see an order block like this, okay, much like in a higher level time frame key support resistance level, we are to calibrate them. Okay, this level here at 94.60 is already calibrated to a small round number, but now think in terms of big round numbers. Okay, we have the 94.80 level institutional up here. Okay, so that's one level to be considered. Okay, what we're going to do is we're going to draw a line on that. Okay, so that may be one of interest. And we have one here that's just a little bit outside of the candle, but you still have to consider it because of static alone. Okay, just the normal volatility in the marketplace. If it goes to 94.60, okay, and the order block dips below that, chances are it could utilize the 94.50 level, the big figure halfway part. In other words, it's a mid figure. So what we're going to do is we're going to have our chart, and I'm going to highlight that level here. Okay, now if you refer back to the previous videos, okay, you're going to remember this term, hidden optimal trade entry. Okay, remember, support and resistance, if it's good, it won't go down to the level twice. Okay, in other words, it will be accumulated and then it won't go back and dip down further. That's the premise between optimal trade entry. Well, sometimes we don't necessarily have a specific price action. In other words, there's a gap between the 50 level and where price is trading in here. Okay, now remember, gaps don't always have to be filled, and that notion is one of the central tenets to this pattern, and this is one of the applications you can utilize it for. So what we're going to do is we're going to have our Fibonacci tool. Okay, and our point of reference here is this is the highest high at the time, okay, going into this order block, and we're going to reference this 94.50 level. Okay, and you pull this up, and what you're looking for is you're going to drop it right on the highest high, like that. So you anchored your 100 level to the 94.50 mid-figure point. Okay, and that's going to give you a range between the mid-figure and the highest high in here. Okay, now if price is accumulating in here, now you are not going to see this Fibonacci tool application anywhere else. This is completely and utterly unique to me. Okay, now I catch a lot of flack for this thing, but I also catch a whole lot of incredible entry points, and I have trades that support it and results that reflect it. So the bottom line is it's going to take a knack for you to learn to trust this. Okay, and the only way you do it is if you play around with it and you do your own research on this pattern. Okay, but it's still an optimal trade entry. It's a retracement within a range. Now, its price has not traded down to this point yet. Okay, but because there's psychological barriers, okay, in price, we have to consider it. Okay, and the way I use it is like this. Okay, so if price trades down to the 94.74 level, 94.69, or 94.63, that would constitute an optimal trade entry, okay, within the order block, with the understanding and premise that it may not get down to 94.60 or to 94.50, okay, or very well may just trade through it and spike even lower and not even give me a pattern at all, okay. But we have to consider this is a range. Even though price has not traded to it as of yet, or if at all, we still consider that because it's a probable range within where price may have a bounce, okay. And I'll give you more examples in this series, but for now, let's just work with this one. And as price moves down into this level, okay, price goes just a little bit through the 79% retracement level, doesn't get to the 94.60 here. Price begins to rally off and takes off. Okay, and there is approximately 100 pips in price swing right in here. Okay, so you're finding the range where price may produce a move of sorts, but it's going to elude you if you're just looking for simple things like this, like here's a low to this high, if price retraces down to a range between this low and this high. That's basic price retracements. This is higher class, different level type Fibonacci stuff. And again, I didn't learn it anywhere except for in the charts. Just just referencing the mid levels, the 50 levels, the 100 levels. Okay, it's applicable at the institutional levels as well, but when it's traded like this application, I use really just the full figure and mid figure levels. Okay, because if the order block is like this and it's around that 50 level, I'm going to be hunting a setup similar to this. Okay, this is again a pair I don't trade, but you can still utilize this this application on any pair of your choice. But again, because I know this is probably went over a lot of your heads, and I don't mean it to be, a braggart, but we're going to go through the process one more time and explain what, again, I'm doing. Price is trading around into an area where an order block on a higher level time frame suggests that we may see a bounce, okay? We are trading near a mid-figure level, okay? And the range on the 4-hour order block suggests that price may dip down into at least that 94.55 level and below it. Now, if it's going to go there, it very well may go to the 94.50 level. It doesn't have to, okay? In fact, I'd rather see it not do it, okay? And that's what this pattern hinges on, okay? So what we do is, again, once we anchor an area where we can clearly identify, and you could do a horizontal line here. I just used this because it's cleaner compared to the two lines we already had on the chart. But you just take your little crosshairs on the little marker here. You anchor it there. You pull it up to the highest high traded during that consolidation. Okay, and as price trades down into it, it'll reach into this range. Okay, and I know it sounds like voodoo, okay, but I'm going to tell you right now, I've blown people away with this pattern over and over and over again. And once you identify how to use it, it's crazy. It's insane how very, very accurate it is. And it's nowhere in any books. It's nowhere in any video courses. I wish I could just simply say, hey, look, here's another reference source you can go to and study it, but it's really unique to ICT. So again, it's one of those things where, whether you like it or don't like it, the bottom line is I use it. It works. It's a pattern that I trade all the time. It's a hidden optimal trade entry, and it's based upon using support and resistance levels as your anchor points. Okay, not necessarily a key swing high or low, an anchor point referenced around price levels itself, that being the mid figure in this case, or a big figure. Okay, so now let's move on and take a look at, okay, we are at the second of the 4-hour order block, potential areas on that Canadian-Japanese yen pair. Okay, and we have this range here. We have the price bouncing off it initially, rallying up, and then starting to come back down. Now, again, you could do a few things here. You could use your basic optimal trade entry, which is pulling a low to a high, and if price trades down to these levels in here, okay, 93.50 is a good area in here because it's around that big, mid-figure level. Okay, but draw your attention back to that 4-hour order block. Okay, this level here is 93.37. Okay, 93.37. Where is that in terms of institutional levels and big figures and mid figures? Okay, notice that we have the mid figure up here. Okay, so if I use that reference point, okay, we have that. Now if you draw the fib with that point, like we just did on the previous example, this is what you arrive at. Okay, let me get that right where it belongs. Okay, so we're finding the range between the mid figure 93.50 and this high. Okay, so you have 93.66 and 93.59.